Everyone's asking the same question: is the AI boom just the dot-com bubble all over again? By the end of this video, you'll see why we're actually moving from just sharing data to creating autonomous intelligence. The history of capitalism isn't a slow, steady climb. It's actually a series of explosive, transformative surges. Scholars like Carlota Perez describe these as technological revolutions. These are moments when new tech reshapes the entire global social and economic order. Today, we're seeing a dialogue between two massive eras, the information revolution of the late 1990s and the AI surge that hit its big bang in late 2022. While some fear a repeat of the 2000 Nasdaq crash, there's a fundamental shift happening. We're moving from the communication layer, which is just distributing data, to the cognitive layer, or the generation of intelligence. Let's look back at the mid-90s. It was defined by a frenzy phase. The internet went from an academic tool to the very backbone of commerce. But financial capital quickly lost touch with reality. By March 2000, the Nasdaq had increased fivefold, reaching a price-to-earnings ratio, a measure of how expensive stocks are relative to company profits, of 200. This was the era of eyeballs over actual earnings. In 1999 alone, 457 companies went public, many with no viable business plans at all. Companies also upgraded their systems all at once because of the Y2K computer bug problem. When the expected demand didn't show up, the collapse was swift. The Nasdaq lost a third of its value in just 1 month. Eventually, it plummeted 77%. But this creative destruction wasn't for nothing. It left behind a physical foundation of fiber optic capacity that eventually enabled the modern cloud. Now, the AI surge shares that same 90s enthusiasm. However, the financial fundamentals tell a very different story. The dot-com era was built on speculative IPOs, initial public offerings, of companies going public, many without real business plans. The AI era is defined by the massive reinvestment of profits from giants like Microsoft, Alphabet, and Amazon. These hyperscalers have $1 trillion buffer of free cash flow. This makes a systemic collapse much less likely than before. Consider the infrastructure. In the year 2000, Cisco reached a forward PE of 150. Today, Nvidia sits at a much more tempered 54. Profitability is up too. During the dot-com boom, 36% of tech companies were unprofitable. Today, that's only about 20%. AI is being built on proven subscription models. We're not just chasing eyeballs and ad revenue anymore. However, a new risk has emerged: the brittle network. This is $1 trillion web of financial dependencies centered on physical data centers and power systems. If the returns on AI investment slow down, the impact could hit the whole economy. It would flow through hidden debts and massive physical assets. So, where do we stand right now? According to the Perez framework, we're in the later stages of the frenzy phase for AI. The big question is productivity. Skeptics like Robert Gordon argue the impact of AI is just incremental. But optimists like Eric Brynjolfsson point to something called a productivity J-curve. This suggests the impact of a new tech is initially invisible while companies restructure. We're already seeing unheard-of productivity gains in software development, up to 34%. Even if the economy-wide impact seems small for now, it's growing. The 90s built the internet's physical capacity through a painful cycle. The AI era is building on that, moving from distributing information to generating intelligence. We might see a correction in unproven applications. But the core infrastructure is a durable, general-purpose utility. We are witnessing the maturation of digital capitalism. We're moving from the eyeballs of the 90s to the complex, autonomous cognition of the 2020s. Thanks so much for watching. If you enjoyed this take, hit that like button. Make sure to subscribe for more stories. We'll see you in the next one.